Hi, and welcome to this week's episode of the Lady Landlords podcast. I am your host, founder of Lady Landlords, Becky Nova. And today we're going to be introducing you to my personal financial advisor, Frank Schursky of Forster and Schursky. So Frank, thanks for joining us today. How are you?
Doing good. Nice to see you again.
Nice to see you too. So to me, my entire real estate investing journey started with you years ago when I came to you in debt, horrible credit, having no idea about investing or anything. And it's been amazing what we've been able to build over these past couple of years. So I'm so excited to have you on. Just so our listeners know how close our relationship is, I've actually had Frank over to my properties for a barbecue. I had my financial advisor at my wedding. So that should really tell you all how I feel about Frank. So
It was a great
Frank,
wedding.
a little wet, but we made it through it. So, but that to me really kind of shows, I just appreciate how much you've done for my husband and I over the years. And once again, it's more than just a financial advisor relationship. We've actually really gotten to become friends, which I love. So I can't think of anything more fun than getting to sit down and actually do this podcast with you. So thank you.
Definitely. Well, thank you. I appreciate that a lot. And I will say that a lot of that work has been done by you and your husband rather than me. But hopefully I was there to help guide you a little bit and help you, work your way through some decisions.
Absolutely. And I plan on still driving you crazy with all my questions for many years to come. So
Questions are good. They're always fun.
yes. So today I have a bunch of questions for you, but the first one I think is going to be really, really easy for you to answer. And that I would just love if you would like to give a simple introduction of who you, Frank the man, is to our listeners today.
Yeah, so so a little bit about me, I guess my history and where I'm at. So I've been at my current company, my parent company, which is Forest Hills Financial Group, for the last 15 years. In fact, today is my 15th year anniversary, kind of randomly that today fell on that day. And I hope to be another 25, 30 years, maybe plus, involved with my clients and my practice. I was able about 3 years ago to start a firm with a partner of mine, actually someone that I brought into the industry to do planning and to build their own practice. And we kind of hit it off as working very well together. So we created a brand together, Forster and Schursky Company. And my goal for my clients and my goal for financial planning is to help clients get what they want, not what I want. And a lot of times, people meet advisors or people to help with money, and they have a certain thing that they do well, and kind of everybody fits into that category, and everybody should kind of go with that strategy. And my goal with our clients and with people that I work with is to find out what they want out of their plan, find out what they care about, and then to help them organize their dollars in places that are going to get them those goals.
So now, did you always want to be a financial advisor?
So
How did you end up in this role?
That's a great question. My father actually, so I'm one of five. I have two older siblings. One's a doctor, one's a teacher. And then I have actually three older siblings, two doctors. One's a surgeon, one's an internal medicine, and then one's a teacher, and then a younger brother who's an art teacher. So I kind of, it's a little bit of finances and a little bit of education. And then my father was in the industry, but more on the management side, where he ran agencies and he trained agents and financial advisors how to plan. And he did that all the way up at corporate home offices, where part of his career didn't really have contact with the public, but had direct contact with the field force. So I would say that, yeah, pretty early on, I would say going into college, like I was gonna be an economics major, and I was gonna work on money and finances, and I like making quick calculations in my head, and I find that stuff interesting. And then the education background, I like teaching and educating and helping people, feel confident about their decision.
That I could see. And once again, many people are going to be listening to this episode on a podcast, so they can't necessarily see us. But if you ever have the opportunity to meet Frank in person and sit down with him, the first thing you notice about him is he's going to pull out some white pieces of paper and a pen. And he even has his whiteboard, but it's literally like your traveling blackboard, if you will, from really that teaching perspective, that you always sit down and are able to show us calculations and how numbers work and illustrations, which are just really, really helpful. So I think that is interesting that you have that the combination of especially what your other siblings are doing. So I
Yeah.
definitely kind of meant to be here.
Yeah.
So within then financial advising, what do you feel kind of sets you apart from other financial advisors, right? There's a ton of them out there. But
Yeah.
what do you feel kind of makes you like really the expert in this field and just kind of sets you apart a little bit differently than the other financial advisors I can find in the white pages, those still exist?
Yeah. That's definitely a tough question to answer, just because, what are the other advisors doing, and what are they so great at or not great at? So I think I can answer it in one way. It's what do I feel is the best way to help a client make a financial decision? And that's looking at everything in one place. That's getting organized, um, understanding where your dollars are, having an idea where you want them to go, um, rather than, I have this incredible product that's going to solve all your problems. So I really think that's, I can't speak to how many advisors out there are doing that,
Mhm.
but I'm a big believer that any decision you make in one area of life affects another area of life. So you have to take into account all those different aspects of a plan. And when you do, it's much easier to make a clear decision. And that's what I think I'm after with a client, is to help them make a clear and confident decision so that they have a good understanding of what the ripple effect is going to be.
Mhm.
And when you do that and you kind of walk into that decision, you have a lot less, um, I guess, look backward, maybe I made a mistake, right? So if you kind of have an idea what a lot of the other things going on from that decision are going to happen,
Mhm.
you have a lot more confidence in that decision.
I agree. And that's something that I really feel that with working with you that has been helpful is let's take a look at the situation, figure out and identify really what our goals are. And that's kind of the questions that gear the conversation rather than just kind of coming in and you kind of saying like, hey, this is the direction you have to go. I'm sure a lot of our listeners being real estate investors can completely identify with that because everybody has their own opinion about real estate investing and using that as a wealth building strategy. But we will get to that in a couple of minutes. I want to stay on talking about financial advisors. To start with, to me, once again, this working with you and working with a financial advisor has really just given me so much financial education that I feel like I did not get in schools, which, and I went to a great public school and still it was something that we never really kind of talked about. So I do think I'm a very big proponent of pretty much everybody having somebody that they could bounce ideas off of and get some advice and learn what other opportunities are out there. But when people are looking for a financial advisor, what would you say are some signs of the right person to work with or a good person to work with?
Yeah, so I think first and foremost, I think you got to feel comfortable with that person.
Hmm.
I mean, I almost relate it to a therapist, right? Like you have to be comfortable sharing, what you've done so far, and sharing what your dreams and hopes are. Um, and I think that, at least in my experience with salespeople or people that are trying to, sell me a product,
Hmm.
if I don't, if I feel like they're going to use what I say against me, I'm going to be a little scared of that person, selling me something, right? So, um, I, I don't think there's any magic financial product out there that's going to solve everyone's product problems outside of, stumbling upon, an incredible piece of real estate that, you know, does 10 times what it was supposed to do, or a business that, grows, outside of whatever you thought it was going to grow to. Um, so I think most importantly, it's being comfortable with that person, because you want to be able to share what, your whole, everything that you have going on in your plan, because a
Yeah.
good advisor, like all the decisions made are all impacting everything. So the more information that you're willing to share with that person, the better advice and recommendations they're going to be able to give you. So I think that's the most important, because everybody has a different personality. Some people like to be sold, right? And that might not be a bad thing, right? But you got to feel comfortable in that. So I really feel that it's the comfort, because from there, a lot of good things can happen. And then
Yeah.
secondary is all the products, but all our advisors, we all have the same products for the most part.
I was going to say, I feel like it's the same when I would interview an accountant or a realtor, that really right, they're going to almost most of the time have the same properties that they could sell you. But it's really, who do I really want to talk to? Who do I want to actually work with? I think I've kind of shared this with you. That there was somebody actually that I met years before that we'd been put in touch. And I really liked the woman. I thought she was great. She was a businesswoman, and as a financial advisor, like I just kind of like looked up to her almost as like a motherly kind of figure. And I really thought she was great. Then when I started dating my husband, they just could not connect. And listening to them kind of just communicate, it just did not work. My husband was explaining what he was doing for work, and it was just something that the two of them just were completely disconnected. And it also was very intimidating for me, because I felt like I could not tell her the situation I was in back then, when I was really struggling financially. So it just was not really the right like personality fit for kind of what we needed. And I think we cannot get through this episode, Frank, without mentioning and giving a shout out to Jesus, who used to be a partner with Frank years ago, that we both still keep in touch with and love. But one thing that was also helpful with him is that he was also Dominican, like my husband, that he spoke Spanish, that was something that as an introduction coming into this. And my husband does not like being sold to at all. He likes to be able to kind of make that decision. And he loves the fact that you always lead with that education and then really let us kind of make those decisions. So for us, that works. For me, I know I'm coming in to buy stuff, sell me all you want. Like that doesn't affect me like it does him. So it does take kind of different people, and you need to really find the person that you can trust. For me, the most important thing is I'm really bad with boundaries. So I need somebody that I could call, text, and email that's not going to get upset with me. So you got the short end of the stick on that one. But,
That's right. Well,
but
that's
everybody
what,
has to find what works.
and I think that's also, what you'll find with advisors is, this isn't like McDonald's, right? Where there's a procedure, and everybody in the industry has to follow it. Now you will find that, certain people that work at certain companies there might be some similarities there. But for the most part, an advisor's going to create their business based on how they want to work with clients. And I think that's very, very important. Early on, it's, someone that might scare you is somebody that might come with a product and come with a solution that's like the best thing. I would say that would be something to stay away from. That's a pretty big red flag. But once you kind of weed out the initial like pure salespeople,
Mm-hmm.
now it's really, a lot of advisors, they spend a lot of time, educating themselves. There's a ton of industry expertise that people go through, to all year round. I can tell you that I go to, 4 or 5 conferences a year minimum, plus all of them in between. So there's a good amount of education out there. So yeah, it's really just, once you kind of get past those initial salespeople, you find some people that have been doing it for a while. It's that personality that I think is the most important thing.
I like how you mentioned a red flag in there. That was actually my next question for you. So what I heard you saying is, when almost like your first introduction with the person, before they know anything about you, before they know anything about your goals or your actual financial situation, if they're just like, hey, I got a product for you, this is what you should be investing in, this is what you should be purchasing it. That to you is kind of something maybe you should be a little wary about.
Yeah, and I think especially when someone calls themselves a financial advisor, is one thing. Yeah, and I think there's a lot of misuse of this term of financial advising, and maybe
Mm-hmm.
there's different definitions of it. But I think when people hear financial advising, they think of investing. And they think of investing only. You can invest in a mutual fund, stocks, managed portfolios, all of the above.
Mm-hmm.
And that's financial advising. And what I think financial advising is helping a client build a plan that's going to take care of themselves for the rest of their life. And it doesn't only involve an investment component. It also doesn't only involve an insurance component. It doesn't only involve a real estate component, or just a savings component. It involves all those components. So yeah, I think that's the key. The red flag is, it's like a snake oil salesman, right? They always have the best product that what's going to solve the problem. But really, I think what we all find in life is that when we want to build something meaningful, it takes time, it takes effort, it takes discipline, it takes mastery, right? So
Mhm.
any amount of financial advising, it's like when we met when you first started, and you had all these goals in your mind, and how you were going to, kind of create an independent income outside of the regular 9 to 5 world. um that hadn't happened yet, right? But you had,
Mhm.
those goals, and it wasn't about, if we do this stock, you're going to get all those things, right? It's like, no,
Yeah.
you're going to save amount. We're going to try to diversify in places that you have access to. We're going to try to look at places that make sense in your world that you maybe can do other things with besides just investing or besides just long-term planning, and then come to a consensus and then build that over time, one brick at a time.
Actually, I'm gonna have to go back when I release this episode. I'm gonna make sure to put on my Instagram at Becky Nova 24. I'm gonna make sure to post my picture that I took of our goals, because we did it. I took a picture of your computer screen in your office pre-pandemic, clearly, but I took a picture of my goals on your computer screen when we were writing them out. And then I also have it time stamped the years later when we actually then kind of looked through and reviewed those goals as we did, every quarter. And then actually said, hey, we've actually need to update our goals because we hit these. We now
Yeah, it was
accomplish
like it
these.
was like 5 out of 6 checks. It
Yeah,
was
I was
pretty
like,
good.
man, we got to pick some new things to kind of go after. So I'm going to make sure to post that picture with this episode, because I just really thought that was so telling when you really can see those changes. And like you're saying, not overnight, but really over some time there. Um, Anything else from like a red flag perspective? If I'm calling around, talking to people, trying to ask some questions on if this person might be the right fit for me, is there any question that I should ask a financial advisor when deciding if I should meet with them and and take them on as my person?
Trying to think if there's anything, a little bit more specific. Um, I
And that's
think, I
okay if
think,
not.
no, no, I think that, what I would be careful with is, I don't want to say reading too much online, because education is always good, right? Any amount of
Mhm.
reading is always good. Um, but I think that you want to be careful. Maybe this is a little bit separate of just an advisor, but you always want to be careful of, taking information that you read online, that you see on Instagram, that you see on YouTube, and kind of assuming that that's now the solution, right? Like all of a sudden I found the pot of gold, right?
Yeah.
Um, and and also, a lot of stuff in media, just in general, there's a purpose behind it, right? So, you bring Susie Orman, for example, what does she do really well? I think she does really well of helping people become very disciplined and think about finances, which is like so important. But what I think
Hmm.
sometimes she might miss things is, she'll talk about a certain product being bad or a certain product being good. And that's where you got to be careful, where, you know, who's, who wrote that article, what's behind that article, what is that parent company trying to accomplish, right? So,
Hmm.
I only bring up Susie because that's a very well-known name. And she's just like any TV, she does a lot of good. And just
Yes.
like anything, there's not everything's perfect. So that's that's, I think, is the big red flags, is, first, someone that's just always trying to sell X specific, and then second is just assuming that because it made sense in maybe one forum, that it's just a blanketed, that's always bad for everything.
Yeah. And once again, it's also just kind of like blanketed for everything. It's also, I do feel between some of that broader scope media, they can tell me something could be good or bad, but we're not talking about how it specifically applies to me. And we're going to
Exactly.
leave another we'll leave another financial advisor, or if we can call him that, nameless, that really feels that property and real estate should only be bought with cash and that there should be no debt. And for many, many people, that strategy works. For someone like myself that is looking to build this cash flow and wants to do it yesterday, waiting to save $1 million to buy an investment property in cash is really not going to work for me. So although it can be good advice for somebody, it's really not something that is necessarily applicable. We have to take this education and decide how it's going to apply to us in our situation. And that's where I think really kind of getting into the nitty gritty with the person that you can share what your specific goals are is really important. So I'm glad you mentioned.
Yeah, and I think to kind of piggyback on that, there's no financial product that solves all the problems. Right. If there was, everybody would just put their money there. No, there wouldn't be all this, conversation about, I got, Bitcoin that did really well this week, or, I'm a real estate person and I'm going to build my whole retirement. Right. There's always going to be that back and forth. So yeah, I think it's extremely, important to see how it's all working together. There's no magic product. There's no magic solution.
On that note, one thing that I would love if you could do for me is to describe what you mean when you say product. I think when financial advisors say the word product, that used to always throw me off because I'm thinking product as like a tangible item I can hold in my hands. So I would love for you just to give our listeners some examples of what you mean when you say the word product, because I think this is a great teaching point right here.
Yeah, so I that's a great question actually, and I do think that sometimes advisors can over use too much industry lingo, as we would call it, because we're always speaking to each other and going to classes and we're talking, learning about this stuff. So, but what is a financial product? I think a financial product is all of the above, right? So it's anything that fits under the umbrella of something that I would save my money and invest in. And, so it could be a savings account, it could be an investment account, it could be a life insurance contract, it could be a retirement account. I would say less the retirement account, and the product would more be what would be inside of the retirement account. So the investment choices that are inside the retirement account. But the reason why I use product is because, again, I don't think there's one solution for everybody. So it's really the mix of different financial product or financial vehicles that client is going to undertake based on what they want out of a plan, right? Somebody that's wants to own more real estate, they're probably going to have their money in different places than someone who's like, I never want to be a landlord ever one day in my life. Like, that's the scariest thing in my life, and I just have no interest in that, right? They're going to set themselves different than somebody that's like, I love real estate and I really want to get involved there, but I've never done it before, right? How do you get started? How do you mix kind of those, two together?
Gotcha. That's a great explanation. Thank you. I do find it, sometimes we do get very caught up in our vernacular, and it's something that I heard so many people say in so many different industries. So one of the things I always like to do in our podcast episodes, and I've done this with our hard money lenders and our realtors, is to really make sure that some of those terms that we just hear all the time can really get that. Where sometimes I'll have no problem saying it myself, that I'm so embarrassed to have to ask an expert and be like, what do you mean by that word? I like to make sure that our ladies can get those definitions here, so that way they can feel confident when they go back out into the real world.
100%. And to add on that, to put it past just financial services investments, but I would say if you're a mortgage person, your different mortgage is going to be products. I have a 15-year, that could be a product. Or in the insurance industry on the property side, those are considered products, the different deductibles or the different things that you're insuring. So
exactly. Every industry is going to have those, and you're right. Within mortgage lending, you hear that word product all the time too. And I'm like, no, but the house is the product, right?
Yeah,
I'm still thinking tangible items. So I'm like, you're just giving me a piece of paper with a really big bill on it. What do you mean that's a product?
What's funny is that brings me back to like being, like maybe middle school, high school. My dad's been in the industry, but hearing again my dad on, maybe a phone call, a conference call, and then talking about product and like, like thinking in my head, like, what do they sell? Like this is not a baseball glove, right? This is not.
Exactly. What's actually being exchanged here? So,
Yeah.
so that's why, like I said, I think it's important to make sure we get some of that just baseline information. So the product of choice within our listeners really is real estate investing. Many of our listeners do diversify, and we are going to talk a little bit about how to kind of commingle some of those different products and options. But I would love for you to share a little bit about your experience with real estate investing and why you like it as a option for people.
Yeah. So, I would say that there's really only two places to build true wealth, um, in this world, right? And I would say that's businesses and real estate, right? And the reason is because you can leverage dollars,
Mm-hmm.
you can scale dollars. Maybe that's an even better explanation, and you can multiply dollars beyond what they're worth. Um, So, a piece of real estate, and I make this analogy where you could have $1 million and you could own one piece of real estate that if it grew by 5%, it would make 50,000.
Mm-hmm.
Or you could take that $1 million and put 20% down on 5 different $1 million properties. And when that 5 properties, which are now worth 5 million, grows by 5%, you make 250,000. Now there's the question of cash flow that it's going to take to make that 250,000, and that's subjective to tenants and all that kind of stuff. But when there's nothing like businesses or real estate where you can multiply the power of your dollar. Right now, where does real estate get a little, where you can expand too much is someone's going to be paying costs for you, right, in the form
Mm-hmm.
of tenants, and there's the risk of tenants not being there. But that, there's nothing like that. And in my opinion, it's if people have the wherewithal to own real estate, it's okay, let's set up someone's finances so that they can do what they want to do. And you're going to need financial products to do that, right?
Mm-hmm.
But the mix are going to be different than someone that doesn't want to own real estate.
Exactly. And this is what we were kind of talking about before with being like, listen, there's all these different strategies and products, but the key part is really figuring out which of those products and strategies are best for Becky versus Frank versus Susie, right? We're
Yeah.
each going to take different paths. We can still end up in some similar place, but we're all going to take a different route. And some might get us there a little bit faster than others, but we really have to look at how they're going to break down for us. And I still remember, once again, on your white paper on your desk, you kind of really drawing out that illustration that kind of showed, even from the example of just having $20,000. If I have $20,000, I can buy $20,000 worth of stock. If I have $20,000, I can actually use that to put it down on a property and then end up with a property that would be worth that $100,000. You can both grow, and those are both variables. If stock market goes up or stock market goes down, I have great tenants, I have vacancies, whatever that may look like. But in the end of the day, I took that $20,000 and either bought exactly $20,000 worth of stock, or I used that to purchase a larger asset, multiplying my dollars.
Yeah. Yeah. No, exactly. And um, there's just nothing like it. Um, and I think that the other mistake that I think advisors have, or maybe even the public to an extent, I think that they make this assumption that if a client's going to own real estate, that means they're going to invest less with me, right? Or they're not going to have any investments with me. Um,
Mhm.
and I personally, I don't think that's the case. I think you've started to see that a little bit. I think that it's trying to figure out that balance that makes sense for that individual client, because there is
Yeah.
risk to real estate.
Mhm.
There's it's not stressful at its own time. Doesn't come with its own risk. And we all know 2009 and 2000, where people were over leveraged and they really got in tough positions. So it's trying to figure out, that nice balance. And I think there's room for both, even for somebody that is more leaning towards I'm only going to invest. I still think they need to kind of diversify to them to an extent. It's just again, probably less than somebody who's just starting to dabble and wants to own a property or two as an added investment, right? Versus like a, a primary thing where that's where I want primarily all my money to go.
Right. And once again, that kind of comes down to the individual. And I think probably financial advising 101 would be not put all of your money in one place, right?
Exactly.
I think we
Exactly.
could at least start there. We don't want to do that. So how would you say that working with a financial advisor can help an investor create a balanced portfolio?
Yeah, that's a great question. And when you say balanced, do you mean balanced as in the entire plan?
More of just being able to kind of diversify it to
Yeah.
once again not put all your money in one basket
Yeah. So
or in one house,
yeah,
I
yeah.
guess.
I think the key is again trying to figure out first how much, right, as in do you want to invest in that real estate. But then you have different categories, right? So you have tax deferred money. That's money that are in retirement accounts that's going to grow without paying taxes, but it's going to
Mhm.
be a little bit less access, right? You're not going to be able to grab that money, especially when you leave a firm, right? Whereas maybe you can grab that money for a first time home buy. Uh,
Okay.
but for investing in real estate, if it's in IRAs, within 401k, you're not going to be able to grab that money. So again, not saying to not invest there, but take into an account how much, what level. And then you have taxable investments like stocks or bonds or mutual funds, ETFs that are not in retirement accounts, and every year they get taxed on a capital gains. Those
Mhm.
are more liquid, but the what makes them semi not liquid is volatility in the market, right? So
Mhm.
just trying to figure out what amount of money makes sense to go into a vehicle like that that's going to have volatility, liquidity if you needed it for a good situation, but still also maybe grow.
Mhm.
And then you have insurance contracts where you can shelter some taxes, you can get some death benefit leverage, and you can grow some guaranteed money that's very liquid. Um, so again, trying to figure out the mix again based on how involved the client wants to be is the key. Somebody that is going to want to buy a lot more real estate is probably going to want to put a little bit less early on into retirement accounts just because of the access to it, versus someone who maybe is going to say, I'm going to buy one investment real estate and I'm going to slowly build to another, but I'm in no rush. Maybe they're
Mhm.
going to add a little bit more to the retirement account or vice versa. So again, it's looking at the whole picture, and taking advantage of how each individual category works based on taxes, liquidity, um, and from there you can make a good decision. And then wherever we invest those dollars, that's a customized decision on, okay, we're going to invest some money here. What are we going to do with it?
I feel like I'm picturing like a sliding scale where it's okay when a person comes in on a scale from 0 to 100, where do they fit for risk tolerance? What are they willing to kind of say, okay, it could be a little bit risky. I'm this age, I'm a little bit farther away from retirement versus, hey, this is something I need to get
Yeah,
done a little sooner. Then kind of that next sliding scale is how much do they, how interested are they in being hands-on in their investments? Are they going to watch their funds on a daily basis? Are they going
yeah,
to want to make changes? Do they need access to that money? And then kind of on that third level, when we talk about real estate investing, saying, well, how much does this person really want to be invested in being a landlord and being hands-on and being involved in all of the things that we have to do on a daily basis? And then kind of figuring out where those scales kind of fit together and then saying,
exactly.
well, based on that, these are probably the products that would make the most sense for you.
Yeah, yeah, exactly. Um, yeah,
So I could see that really, once again, that comes down to such the individual level of what really is best for that person.
yeah.
What
But
would
I
you
think
say are, go ahead.
I was just gonna say, I think, the most important is that a person can do it all, and they probably should do a little bit of it all. Just the ratios are going to be different for each person. Just like someone being healthy, you got to be sleep well, you got to eat well, and you got to exercise. And people are going to do a little bit different of
A
a
little
slightly
percentage
right,
different.
right, right. They're going to slightly be on different sides of those equations.
Now, it's been many years since I have been in school, so I do not remember, I do not know what health class these days looks like in our
Right,
food pyramid that there used to be.
right,
But
exactly.
is there any type of recommended breakdown between what should be an insurance versus emergency fund? We get
Yeah,
this question a lot in Lady Landlords, where people are saying, hey, if I, out of my the 100% of my wealth, is there a
yeah.
recommended guideline for what I should put
Yes.
in these different
So,
buckets?
so I think there's more like ranges, like not to bring up health, right? But there's a
Mhm.
blood range. I actually don't know, right? But there's a blood range of where you want your cholesterol to be. And
Yep.
if you're within that range, right? So hard to kind of explain. Visually, it'd be a little bit easier. But let's take real estate out of it, because I think real estate is
Okay.
its own game, and your own personal real estate is not really part of your wealth building endeavors, right? So it's really great.
Hmm.
You're paying off your own mortgage. You're not paying somebody else's investment property, right? But we still want to save 20% on top of that, right? So
Hmm.
let's just put aside real estate for a second. Um, first is you want a certain amount, anywhere between 3 months and a year worth of liquid assets based on who you are as a person, right? So some people are going to feel a little bit more comfortable with more like 12 months of savings in a savings account. I've seen that. I've also seen
Hmm.
36 months in a savings account, right? I'd probably
That's at
try to
mine.
right? Try to get the 36-month person maybe more down to 24-month, right?
Hmm.
And maybe the 24-month person maybe down to 6 months, depending, right? So somewhere between 3 and 12 months of save, right? And then
Hmm.
once we kind of get that established, there are two things going on. There's the money that I have saved currently, right, and
Hmm.
what to do with it, right? So how much percentage am I going to leave for my next purchase, right? How long, is it till my next purchase, right? So you have the assets that you've already saved, but then you have the new money coming in, and what is that going to look like, right? So
Hmm.
sometimes when you take into account the money that you saved and the new money, and then the distance out of a purchase, that means that some of the liquid dollars that you have maybe can be invested, right? Because you have future money coming in, you have a certain amount safe, um, and you have a year and a half or X amount of dollars. So the new money is going to come in, is going to fill up whatever amount of bucket that I invest, and I'm still going to be able to buy that place. I'm still going to be able to take advantage of the market, which is what everybody's talking about.
Hmm.
And I'm still going to have some liquidity if I need it, right? Because we can always sell investments. So I hope that answers your question, but that's the
Yeah.
first is liquidity, and then second is figuring out some of the other things you want, and then we can talk about future cash flow, which now we can get an idea of whatever we have today, what can be invested, and where it should go.
Right. And that's also important to then say, especially as now we're growing portfolios and bringing in extra cash flow, then the question becomes, well, what do we do with it? Do we
Yeah,
always have to buy more real estate? Or what other places can we put it? Once again, either being that tax deferred option, what's really then best for that
yeah,
holistic picture, once again, as we continue to now grow our wealth, which is the whole goal that we're trying to
yeah,
get to, anyways.
yeah. And I would say that I think that what happens in the industry is people put a financial product against another financial product. So a 401k is better than a life insurance contract, or right now, cryptocurrency is better than the stock market, right? Or
Hmm.
life insurance is better than all of them because they're all going to do poorly, right? But what I
Right.
think it is more of that big picture. What does a life insurance contract do? It grows tax deferred with a guaranteed rate, right? So, with a death benefit and some waiver premium. So, what do I get from that? I get some guarantees. I get some comfortability. I know I get very predictability with that. Well, what that
Hmm.
means is that maybe in my investment component, because I have all those guarantees, I can take a lot more risk, right?
Right.
And oh, well, in the life insurance component, I have liquidity to buy real estate. Okay, maybe that's a good option, because what that allows me to do is actually be in the stock market with my other dollars, because
Hmm.
I have some guarantee here to buy the real estate I want to buy, which now frees up money. So I'm a big component of having different financial products help other financial products, right? And
Yes.
how that's the key, right? It's that they're all working together.
Yes, and that's actually one of the things I definitely wanted to make sure we addressed on this call today, because I love when you talk about that idea of being your own bank, right? And creating those strategies and putting those different products together that will then allow us to kind of help ourselves rather than having to always kind of go to an exterior. So one thing that I know that you and I have talked at length about is whole life policies and how that relates to real estate investing. And can you share a little bit more with our listeners about that type of strategy?
Yeah. So so how do I frame this up? So life insurance, I think whole life insurance specifically is one of the is a taboo product, right? And it's, I would say, even more than a taboo, because it is around for 160 years,
Oh
and
wow.
it's always been around since 1860, right? You have whole life insurance contracts, but it's very controversial, right? So I think it's highly misunderstood, and again, there's a lot of my product, a universal life or my retirement account or my investment, is going to produce a better rate of return than my life insurance contract, right?
Hmm.
Rather than thinking about, well, my investment account does X, it gives me the opportunity in the market and it gives me capital gains tax. Well, my life insurance contract gives me tax deferral.
Hmm.
It gives me a guaranteed rate and a death benefit, right? So like if I own real estate with somebody, I have a death benefit, God forbid, to pay off a mortgage, right? There's different components. I have a disability component that would contribute the money that I'm paying. And what you
Hmm.
get with this is you get an investment account that's going to grow guaranteed, tax deferred. So
Yeah.
when you're looking at the entire picture, and I'm trying to buy real estate, oh, you know what? Maybe that's a good place instead of maybe some savings, right, which gets zero interest. I could have money in a life insurance contract that's going to grow at 4% over a time and not pay taxes.
Yeah.
And at any time, I can take the money out to buy more real estate, right? So it's
Hmm.
just another, place to hold money. So the question is now, how much money should, if that's something that makes sense in someone's world and they like the liquidity, they like the access, they like the long term, they like the death benefit. Um, okay, I have X amount and all over. How much money should I put into that? Because it's going
Hmm.
to provide me those things, and because I want to buy this amount of real estate. Um,
Yeah.
so, you know, whole life can be, it can be controversial, uh, but it can be a really, really great foundational product that is always going to be there and consistent. Which, what do we want for real estate? We want access to money that we know is always going to be there, right?
Correct.
Because just like anything, I think this, and you've recently like kind of given up some opportunities because they weren't the right opportunity.
Right.
So I think the key is when the iron's hot, right? When you find that place, do you have money to go get it, right? And if all the money's in the market, right, and it's down, that's not a great place, right? So we want some money in the market, but not all of it. If all the money is in a savings account, we're just not getting any interest.
Hmm.
Um, so where else are you going to put it? So it's a great opportunity for that money that's liquid, that you're going to use for other things, that's going to grow long term. And there's a lot of other ways that it works, but that's kind of how I see it. I guess
Yeah.
melding with real estate.
And what I really like about it is I feel kind of how you're saying, well, I can either put it in the market, but if the market's down, then I maybe not, I have to give up that opportunity to buy that property because the market happened to be down that week. And now I don't have the liquidity that I need to purchase that property. But on the other hand, it's sitting in a savings account, but it's not accruing any interest. It's not helping
Yeah.
me there. So what I actually like about whole life is that I feel like I get a couple different benefits from there, but it really gives me the freedom and the opportunity to choose to use that how I want. It's Yes, it's kind of just building upon itself, just like a savings account would, yet it's still liquid in the way that I would like it to be. So I kind of have the best of both worlds there, and it's really at my disposal and at my option
Yeah.
to use how I like it.
And
So
I want to
nothing's better than that.
address, one quick thing. someone that's looking in, they would see that a life insurance contract, a whole life contract specifically, is going to have not a lot of cash value in the first year or two. There are ways to design it to kind of improve that feature. But what we know is that those dollars that are lost early are going to be made up later.
Right.
And whatever balance is in that contract is liquid and accessible. So sometimes people get caught up with, well, I haven't broken even yet, right? It's 10 years, I haven't broken even yet. You're guaranteed to make money, and it's coming down the line. And that actually is what makes the current balance actually liquid, because you could take the money out and put it back in, and you're still going to get that growth as if you never took it out. So just starting to understand that, again, real estate and investments, there's no good or bad product. It's how you utilize them. And what do you see? Financial institutions, you look at their books, they have money in the market. They have money in T-bills, they have money in bonds, they have money everywhere, and they have a ton of money in whole life insurance because it's a great place to put some amount of money. Shouldn't be all your money, just like anything. But it's a great place to put some amount of your money, and they have liquidity and they have a death benefit.
Exactly. Once again, it's one of those strategies, one of those tools in our toolbox that we have that we can use how best fits for us in our situation. Now, before we wrap up here today, one of the last things that I wanted to make sure that we touched on is a strategy called cost segregation. Now, once again, we are coming up on tax time, if you will. Clearly, once again, Frank is a financial advisor. He is not my CPA, but we've actually talked about cost segregation within our plan for wealth building. So can you talk a little bit about what your role as a financial advisor is in that, and maybe even just start with a definition of that as well for some of our members?
Yeah, so let me frame it up, and then we'll jump into the definition. So, primarily, like, there's two things. I'm trying to help someone coordinate their plan to their goals, right? Where their money is to their goals. But what I'm also trying to do is find money that a client may have left on the table, right? So if there are ways without taking any more risk to recapture dollars, it's an advantage, right? Dollars that would be on somebody else's balance sheet growing could now be on your balance sheet growing. So when we own commercial real estate and residential real estate, those properties are depreciated on a 39 year for 27. Okay, 39 year for commercial, 27 for real estate. Right. And if you had $1 million property in each of those categories, it's pretty simple. It's 1/27 or 1/39th you get to deduct on your tax return every single year. But when you buy a new air conditioning unit, or you put in new rugs or flooring, or whatever you do to a building, the IRS actually states the length of that property, right? So if you have a piece of air conditioning unit that was $10,000, the IRS says, well, that unit is going to last 10 years, for instance. So we divide 10,000 by 1/10, and we get $1,000 deduction on that property. So what cost segregation does is you bring in an engineer into your buildings, right? And things that are already part of your building, not new things that you're adding, things that are already part of your building, or maybe part of the infrastructure, or maybe even like the parking lot. It has a lifespan. At initial purchase, or and up to 5 years or 7 years, depending on the situation, you can categorize all that into 5, 7, 10, or 15-year property and accelerate the depreciation. So an example of this is somebody who bought $1 million building, but if they could find that 30 or 40% of that building was 5-year property, they could take $400,000 if it was 40% 5-year property and divide it by 5. So now they would have an $80,000 deduction for the first 5 years, which means
it's huge.
$40,000 or $50,000 in your pocket to go buy another piece of property.
Yeah, that's a game changer for many of us. Absolutely.
Yeah.
Thank you.
any amount of dollars that we can find. And that's an elevated version because you need a decent amount of real estate for that to make sense. You got to hire engineers and all that stuff. But find money to reinvest if you're a right if you're a person
No.
that is good at that.
100%. And once again, that goes back to almost those levers we were talking about a little bit earlier, that it does make a difference between your own risk level, also what you expect to do with the real estate investments. For some people, we're looking just to bring in an extra little extra income to help out our families, and other people are really looking to build that multi-million-dollar empire. So these are all strategies that are going to be important for us to be able to employ. So I appreciate you walking through cost segregation and giving us an idea of if that might be something that we need to look into more. So thank you. Any last thoughts or any last strategies that you wanted to share with our group?
What I would say is, last thing is, don't get caught up, just like anything, don't get caught up in fads, right? And what I mean by fads is, like, the time to buy Bitcoin and make millions and millions of dollars was 2010, 2009, right?
Yeah.
I'm not saying that Bitcoin and crypto doesn't have a place and that people can't grow their money.
Mhm.
But it's gotten to the point now where there's a lot of volatility.
Mhm.
And you have to be okay with the amount of money that you're investing. I mean, they say when you go to the casino, you bring whatever you can lose, right? You don't
Right.
bring, you're right. You don't bring your credit card and the down payment on your next house, right? So don't get caught up with fads. There's no magic solution, easy solution, just like anything in life. It's going to take the blood, sweat, equity that you've learned over the last 5-6 years and plus to own real estate. And there's probably been some growing pains and
Of course.
you learned a lot, and that's what's helped you with the next purchase. So
Right.
discipline, being a really, really good saver, is going to get you a lot of the way there. And then look at how all the financial products fit together is the biggest thing.
Agreed. Frank, thank you so much. I think that's a great
A
note to
pleasure.
close on today. So I will make sure to put Frank's contact information down in the show notes. So if you would like to reach out and talk to Frank about your specific situation, please feel free to do so. Also, make sure to hit that subscribe button so you do not miss the next episode of the Lady Landlords podcast. Thank you very much. And I will see you all next Tuesday when we release next episodes. Thank you very much. Have a good rest of your day.